Good day, fellow investors. One of the most requested stocks for me to analyze with a barrage of comments was UPS. However, maybe it's not a good day for UPS investors because the stock has been in a downward trend. However, the question is whether this is now a value investment or value trap, because the fundamentals look very cheap, especially compared to the market, and the dividend yield of almost 8% is extremely tasty. We'll do a standard UPS analysis, but the basis will be why a dividend cut is imminent, how the competition factor is huge, and how you can see the difference in the capex. Let's start with why is UPS stock down? Because when you look at this, it's pretty clear. After 2 good years when everyone was at home ordering online, there has been a slow, let's say, diffusement of that pandemic effect, and now we are here among other things. If we ask AI what's going on, weaker volumes, and they are reducing their reliance on Amazon. This is a huge factor. Management decision to, let's say, lose its biggest customer because they were not happy with margins. We'll discuss that later. Strategic shifts, of course. There is trades, there is B2B demand, a little bit going into that recession. And if we look at analyst recommendation and target prices, everything is now going negative. Not 2 years ago when the price was high, everyone was an optimist there. They are changing things now, so never ever take any recommendations from Wall Street analysts. Because look at this, the target actual from average Wall Street when the stock was at its peak was 241. The stock now is below 100. And as the stock goes down, that's how they adjust their targets. Forget about Wall Street, but it's good to check how Wall Street thinks, because there is a high number of strong buys when it's definitely time to sell, and this is sell. Whenever Wall Street says hold, that means sell. So now with a lot of sells for Wall Street, now it might be interesting. But let's dig deeper. If we look at earnings, consensus earnings for 2025 were just growing, and then the trend started declining. And here you see how even analysts adjust their earnings down, and we are now around $6 per share for 2025. Actually, $6.51. The trend is negative, but the expectation is that earnings will start growing again in the following 2 years. If this happens, that would be a positive and might turn around the stock. Here you can see the chart bottoming in 2026 and they're growing. We'll discuss that too. Let's dig into what's going on with the business now. Look at the earnings and the conference call. Just a funny comment here on this picture. When I see a truck like this in the middle of nowhere delivering, yes, it can make you proud, but it can make margins and profitability questionable because the price is the same, but delivery is very costly. So not something I would put on a conference call slide deck. By the way, for those who are interested in what I'm doing, my 15% yearly performance over the last 7 years, my portfolios, my research platform, you can check these videos there or directly check my research platform in the link in the description below. If we look at the speakers, Carol B. Tome, 20 years on the board, and Home Depot passed, and now trying to turn around the ship already for a few years with UPS. If we look at earnings per share, it's going down a little bit. Okay, consolidated results down 13%, revenue down 2.7%, so they lost on volume, but they are keeping the higher prices. However, that's not improving the situation with earnings, as margins are also lower. So there are some costs that are not directly adjusted there. They say that the business climate is not good. So consumers are, let's say, spending more in restaurants than ordering online, so impacted by unfavorable consuming behavior, manufacturing activity remains soft, and then tariffs and things like that. However, the key, they have decided to lose Amazon as a client, and now they are working on accelerating the glide down from Amazon because they weren't happy with the margins, and they are UPS and they are better than Amazon from whatever perspective of legacy or whatever. By analyzing UPS, I felt one thing. They are angry, hating Jeff Bezos. It's really, we are UPS, we have legacy, you should do business with us just because of the brand. Well, that's unfortunately not how the world works right now. Jeff Bezos knows it. It's all about convenience. How fast can somebody bring to you what you want right now? Jeff Bezos is working, is scaling on that, and UPS is there, oh, we have a fancy, nice truck. Anyway, ground saver, saving of 3.5 billion expected. Okay, but will that justify the revenue decline? That's something that we'll see at the end of the year, because you see here volume 7.3% decline, and that is a big hit in the US, because if you lose volume, when it comes to these delivery businesses, in my eyes, it's all about scale. Scale, scale, scale. That truck has to be full, so that it pays to go that beautiful scenic route. And if you on purpose decide to lose volume, that's a huge risk, a huge bet to take. Okay, internationally things are going standard, okay, nothing wrong there. But here we come to the second point. Cash from operations. Free cash flow is just this, which means that the dividends paid are totally unsustainable, and I think they have cut the buybacks right now, which we'll discuss now. So based on free cash flow, based on also potential free cash flow in the future, it's very likely that the dividends will have to be cut, and there is another reason that I'll discuss later. They have not providing guidance, which is another big question. As a business, if you don't know what will happen or what can happen, they say their scenarios are wide as their own truck marks of whatever. Well, if you don't know what will likely happen, how can you make decisions at all? So it's really a management issue here now. They have pivoted from Amazon and now they are lost. And the consequence is, of course, clear here with the buybacks again. Here at 84 they are stopping. They did the buybacks at the beginning of the year, so at almost double the price. That's how you destroy value. Again, capital expenditures, I've looked a little bit at things, so the dividend has to be cut because there simply isn't enough free cash flow. When you add the interest payments, it's going down. If we look at the situation, okay, we have had the pandemic effect, very positive, and now it is diffusing a little bit, and perhaps it's just returning to normality, but they want this, they enjoy this, and unfortunately it's not coming back. Plus, everyone was making money here, which means everyone invested in assuming this will be the trend forever. That didn't happen. Now you have overcapacity, which means low margins and low prices. This is typical for any kind of business cycle. If we look at the balance sheet, again, long-term debt is up 4.5 billion just in the last 6 months. Okay, current portion down 1 billion, so 3.5 billion up in just 6 months. This shows you how the dividend is unsustainable. Another thing to mention here is legacy pension liabilities that are also extremely high and will have to be paid, especially if the market goes down or however their investments are there calculated. This can easily go back to where it was in the past. You can see here the decline likely with the market going up or down. Not something that I investigated deeper because it's not significant now, but it can be a risk in the future. If we look at the cash flows, okay, we have net profit and then cash from operations, just going back to, let's say, normality here, but we look 4 billion in capex, they are lowering it now. Of course, you can see here higher capex when they had the money, but then again, repurchases of stocks extremely high when the stock price was higher, 2021, 2022, and now that the stock price is low, we are deleting the buybacks. They need 5 billion for that dividend so that they can grow that trend, and I think here is where they got too exuberant. Perhaps with the 3.5 billion and not doing these crazy buybacks at those prices, this growth trend could have been sustained. Now that will be stopped. Free cash flow for the last 12 months, 3.5 billion. That's not enough to sustain the dividend. Expect an UPS dividend cut ahead. And when it comes to dividend cuts, those are never priced in already. If they announce in the next month, already in October, that they are going to cut the dividend, that means that the stock will go down. All those dividend investors will go on the sell button because now the juicy 8% is still holding. But when they see the cut, then they go on the sell and then the stock goes down. ETFs that hold all these automatically are forced to sell, and that is again an irrational market situation. When the dividend is cut, we can then again look at whether there is value with UPS or not. As said, share repurchases have already been completed, pension contributions, etc., and then don't know what's going on. If we look at the financial summary, it's likely the free cash flow is going lower as they are losing volume. Perhaps if a recession comes, it will be even worse. The dividend is not sustainable. The debt is piling, which is idiotic to pay a dividend and then take on debt, because here you are sure to get interest forever, and just to make those shareholders think you're doing the right job. You are not. What will turn the ship around? Well, let's look at the earnings conference call to just get a feeling about the communication there. They, again, giving away business is something I don't understand, and with these businesses, for me, in my opinion, it is about going bigger. Why are they reducing their Amazon business? It's their decision because they are not happy with the margins. Okay, they say it is something like that, but Wall Street analysts in the pandemic, they projected growth forever because that's what analysts do. They look at margins, but as a value investor, I look at absolute wealth created. If the Amazon business was creating $1 for shareholders, then you keep it and you focus on trying to make it 2, maybe $1 billion or 2. You try to, okay, this is Amazon, how can we source so that we are the leaders? Just giving business away in this circumstance, it's very hard to wrap my head around it. The pandemic effect is winding down, more spending in restaurants, automobiles than essential items. Of course, people already have their houses full of shit and now they are enjoying life a little bit more. Manufacturing activity, despite all, is still soft in the US, etc., etc. Average US volume declined by 7.3%. Then they discuss tariffs a little bit. They are trying to grow inorganically, doing acquisitions. Okay, scaling, but if you scale, then you are not giving away Amazon's business, if the goal is to scale. Sorry for that, but okay. Okay, yes, you're going to save expenses, but you're going to also lose revenues. If you lose revenues from your biggest customers, you will also lose that efficiency, that margins, that's all. And then the discussion is all about Amazon, 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 where I see that they are in a clash there. It's an ego thing. I think the management of UPS has an ego problem. Amazon is coming in, Jeff Bezos is coming in. He's more efficient, he has no legacy issues, he can invest, he has the cash flow, he doesn't pay a dividend. You can't beat him. That's it. Look at this. Amazon 8 billion in Japan, 700 million in delivery, 4 billion to expand its rural delivery network, blah, blah, blah. 4 billion just for North America and just for this. If we look at the total capex of UPS, it's less than 4 billion globally. How can they compete with Amazon? They can't. And Amazon, if they are coming in and they want operational, efficient, automation, whatever, they have the money, they will do it, they will scale it, they will eat up, they will gobble up this old legacy, even brand businesses. They are just asking there, are things worse in the guidance? And then if you read, if you listen there, they don't know. How can you manage a company if you don't know? Further, on the risk, there is no US recession. AI has not yet impacted jobs, less consumer spending. When that happens, then you're going to Amazon because it might be cheaper, not around. Also, a recession would put the nails into the coffin here for UPS. What will happen? The CEO will get fired. She will get her 50 million of compensation. Bye-bye, new CEO, new turnaround. That's how it goes on Wall Street. Carl Icahn has been saying it for 15 years. The biggest problem of US companies is management, especially in these legacy ego management businesses. The key question is always about margins, but the key questions when it comes to that cash flow and dividends is the dollar you are creating. $1 more is $1 more. The margins is not what pays the dividend. They are automating, but they cannot invest as much as Amazon. So just investing summary, the dividend should be cut and should be zero for the next 5 years if they hope for survival in this extremely highly competitive environment, especially competing with Jeff. They're going to be smashed by Amazon. Just look at the capex. Amazon is spending 120 billion a year for the ecosystem. They are spending 4 billion a year on some kind of automation. And that's where they are destroying value to keep Wall Street or the dividend receivers happy. They're focused on the now, not on the 5 to 10 years from the now. Thus, the company is on a destructive trajectory. When it comes to risk and reward for the investment, the market cap is 70 billion something. Perhaps at 40 billion, it will be interesting for someone for the infrastructure, Bill Ackman coming in. Perhaps the turnaround is based on hope, economic activity. If you're increasing your debt by 4 billion, you know you're in trouble. There is no moat. It's extremely competitive and the capex from others is huge. So when it comes to our value investment quadrant, the risk and reward is simply bad. I'm not even putting it on the quadrant, but just to give you a perspective, I think even the S&P 500 is now a better investment than UPS because maybe there is a 20% chance they will turn it around. But if they turn it around, do I get a 5x to justify the risk? No, because if the stock can crash another 50% in case they cut the dividend and they say we are going to turn this around in 2028, even more than 50%, you need a 3x to justify that. Forget the pandemic boom, because this was exuberance, this was crazy and everyone was expecting this. Reality hit, which happens most of the time, especially in these cyclical competitive environments. So that's something that you have to forget. We are now based on trend, and you can see this is not a compounder, this is dividend survival, and now we are in disruption times, unfortunately. So, oops, that's all I can say about now. I don't think it's a value investment, it's most likely a value trap. Of course, there is this 20% chance that a miracle happens, but the outlook, the risk, does not justify any kind of rewards in this highly competitive environment. Hope you enjoyed this. I'm looking forward to your comments. Check what I do, check my value investment quadrant for better dividend yields, and I'll see you in the next video.